Good morning or good afternoon. Thanks for joining us. I'm Todd Rosenbluth, head of ETF and Mutual Fund Research at CFRA, and you're joining us for the hedging uncertainty for all of 2021. I'm joined for this webinar by Graham Day, who is Vice President of Product and Research at Innovator Capital Management. We picked a good day for this with the market volatility certainly picking up. We're going to jump into the presentation. Just to recap, this is our first ETF webinar in 2021, just recapping what an amazing year it was in 2020. Record overall ETF flows, record fixed income flows. We actually saw fixed income ETFs punching above their weight. Actively managed ETFs were particularly popular, both in flows with ARC investments leading the charge, but a lot of new products that have come to market, ESG and thematic strategies. But perhaps the most surprising thing, if we look back on the year, is how many and how popular these defined outcome products have been. We're going to spend a lot of time going in depth about how these function, how they work, how you should use them in your practice. So if you're interested in that, you're at the right place. Also, just want to highlight that we at CFRA had a great year in 2020. We rebuilt our holdings-based ETF research, integrating our first bridge proprietary ETF data. And we're honored that we won the Best ETF Research Award from ETF Express. I'll move us to the next slide just to remind you, if this is new to you, the way that we look at ETFs is a combination of leveraging our top-down expertise from a market commentary and sector and industry research with a bottom-up approach to covering individual stocks from a valuation and risk perspective. On the next slide here, you'll see how that fits into the overall research process. We're bringing the best of our forensic and our fundamental stock research into our rating methodology to offer a more forward-looking approach than others in the industry, focused on what's inside the portfolio, and then looking for funds that have consistent returns and that have relatively low fees. We rate almost 1,900 ETFs today, many that came out in 2020. So we're certainly keeping up with what's going on within the broader industry. And then lastly, if we can move to one more slide, is that even though we're partnering with Innovator to talk about these defined outcome or buffer-oriented ETFs, we don't manage money. Research is all we do. We don't have an asset management arm. We have just unbiased ratings. And you can have confidence that when we're talking about an ETF publicly or seeing our research, it's because that's what the data is telling us, as opposed to having our thumb on the scale. So we're really excited to be bringing to you commentary from asset managers, but we're independent. And with that, let me bring Graham Day from Innovator Capital Management into this. Graham, thanks for joining us, and excited for you to share with our audience more about defined outcome ETFs.
Yeah, Todd, thank you so much for having me. And I think you're right. Today is a great day to talk about products that have built-in buffers with the volatility that we're seeing across the board. If we don't mind jumping to the next slide, just a little, one more slide, just a little background on Innovator. So we're going to talk to you today about our defined outcome ETF lineup. And these are products that allow you to know potential outcomes prior to investing. Never before available in an ETF until we brought these products in 2018. And we think that these are incredibly relevant products in light of the current market conditions that we're seeing. Some brief background on who Innovator is. We were formed in 2017. Our founders were the two founders at PowerShares ETFs, now known as Invesco ETFs. And this is why Innovator exists. It's for these defined outcome ETFs. This is why the firm came into existence, and we want to be and view ourselves as market leaders in this space. So before we jump into what defined outcome ETFs are and how you can use them, if we go to the next slide, just a little backdrop on what we're seeing in the markets, and again, why we think these ETFs are so relevant in light of what we're seeing in the markets today. First, let's look at equities. Equities, we are seeing stocks at record highs. That's no secret to anyone. And we're seeing valuations also at record highs. Now, one of the most common criticisms to that argument is, well, you're not accounting for these ultra low interest rates that we're seeing in the market today. Well, when you do essentially adjust for interest rates, you can still see that at the time of this slide, the 10-year was at 93 basis points. The median PE on the S&P 500 over the last 25 years has been 25 times earnings. Today, we sit at 27 times earnings. The market now is even more overvalued given interest rates have continued to move higher. The 10 years is back above 100 basis points. So for those investors that are invested in the stock market or have had money on the sidelines, do you put more money to work at these levels in the equity markets? That's a tough conversation to be had. If we go to the next slide, what about bonds? Well, we've had some clients looking at their allocations to some of our products or their equity products. And the thought is we want to take some risk off the table, but do we rotate to bonds? Bonds perhaps look, the picture may be uglier than equities. We have not seen a sustained bear market in bonds for decades, but hopefully this chart illustrates the point with bonds is the upside potential remaining in bonds is very small. The downside potential is rather significant when put into historical perspective. So where do you put client money to work? How do you keep clients invested? You put them in stocks unhedged, you put them in bonds with ultra low yields, record high interest rate risk levels. This is why we think, if we go to the next slide, our defined outcome ETFs are so valuable because you can know prior to investing exactly how much upside potential you have in the stock market, but you also have the certainty of built-in buffers to help you navigate markets like we're seeing today. Now, defined outcome investing is not new. Innovator did not create it. Defined outcome investing has been around for decades in structured notes, in indexed annuities, what we think far less efficient wrappers that have added fees, complexity, and confusion for many advisors today. The ETF wrapper, we think, is a game changer, not only for the clients, but also to enhance the advisor experience in utilizing defined outcome payoffs. So again, what we're going to talk about today? We are going to talk about the defined outcome ETF lineup, but specifically focus on our lineup of buffer ETFs. These are the first series of defined outcome ETFs that we brought in 2018. Buffers on the S&P 500 that what they allow you to do is over a 1-year outcome period, invest 1-to-1 to the S&P 500 or another well-known benchmark index up to a cap. And in exchange for that performance cap, you have a known buffer of either 9, 15, or 30%. Now you'll see in the name convention of these ETFs, buffer equals our 9%. Power buffer, our 15% buffer level, and 30% is our ultra buffer level. Now the ultra buffer is a little different. The first two buffer against the first 9 or 15% of losses. The ultra buffer will buffer you starting at -5% all the way to -35%. So you take on the first 5% of losses, but then are buffered after that. So what does that mean? Let's look at that first rectangle on the left-hand side. The Innovator S&P 500 Buffer ETF has had average upside cap of 17%. So you would participate 1-to-1 on the S&P 500 up to that 17% cap. And you would have a known built-in buffer of 9% over the full 1 year. Another benefit of the ETFs is unlike a note or an index annuity, the product does not come due. It's not a taxable event. The product will simply rebalance for you at the end of the 1-year outcome period. We will always reset to the buffers of 9, 15, or 30%, and then you will be presented with a fresh upside cap that will be determined at that time. We have a monthly series on the S&P 500, the buffer ETFs. Our February series is one that we'll spend a few minutes towards the end of the presentation talking about. Our February series, we already have in market. Now, the February series has a 1-year outcome period that starts at the end of January and runs through the end of January of the following year. So we brought this product in 2019. So its outcome period is set to come due at the end of this month. So just a couple more days left in this outcome period. And at that time, again, if an investor is invested in one of these products, they do not have to do anything at the end of the outcome period. Their buffers will be set on the close of business Friday, and they'll have, again, the fresh buffers and then a new upside caps. So if we go to the next slide, let's unpack what does this mean? What do I get with buffer ETFs? Maybe focusing again on our February series here that will start a new outcome period this coming Monday. The benefit of these ETFs, again, is knowing what you're going to get before you invest. So let's look at that major sell-off potential market environment where the S&P 500 or the benchmark index is down 30%. As we mentioned earlier, the Innovator Buffer ETF has a 9% buffer, so you would be protected against the first 9% of losses and then participate in the next 21%. The Power Buffer, you're buffered against the first 15% of losses, so you would be down 15%. And then the Ultra Buffer, you're buffered from -5 to -35. So in this case, you would simply take on the first 5% of market losses. A normal market correction, the S&P is down 10. The 9% buffer, you'd only be down 1%. The 15% buffer, you'd be flat. And the Ultra Buffer, you would be down 5%. Growth market, you're going to participate 1-for-1 on the full upside of a growth market. And only in high growth markets will you experience hit your performance cap, in this case of 5, 15, 10, or 7%. Now, these products are becoming even more relevant as the market continues to move higher, as many are no longer expecting. We've had such a rapid recovery coming from the depths of the COVID crisis. They're not expecting the market to give them 30%, 20%. And so we think, again, now is it's a timely opportunity to look at these types of products to maintain equity exposure, but again, have that benefit of known buffers against losses. So if we go to the next slide, let's take a look at what happens during the outcome period. We just unpacked what happens over a full 1-year outcome period. Now, it's important to remember, I'm going to hammer this 1-year outcome period because that's where you will achieve the full defined outcome. During the outcome period, you'll see in this graph, this is an actual example of one of our ETFs and how it performed over its full outcome period relative to the S&P 500. This is our S&P 500 Power Buffer April series. You'll see the ticker PAPR. We'll touch on the ticker convention a little bit later in our presentation. But what this highlights, you can see PAPR is the dark turquoise line in this bar chart, in this graph. And the light blue line is the performance of the S&P 500. During the outcome period, you will lag the S&P 500 on the way up and on the way down. But again, the important thing to see here is that if we look towards the end of this graph where the S&P 500 was up 20%, if the S&P we had finished the outcome period at that point and the S&P was up 20%, we would have hit our performance cap of 10.6%. But you can see that we weren't fully there, and that's because there was still some time value left in this outcome period. But we all know what happened in February and March of last year. The market had a 34% drop, peak to trough. But you can see here that this product did exactly what it was supposed to do. Over the full 1-year outcome period, where the S&P was down nearly 9%, this ETF buffered investors against full market losses. The ETF was down 73 basis points, and that's net of all fees. Our fees are 79 basis points, so it actually did a little bit better. Perhaps more importantly is the volatility. Volatility was cut in half. The max drawdown was cut in half. And again, this is the benefit of knowing that people who bought this product when the S&P dropped below that outcome period buffer of 15%, they knew I have a 15% buffer, and it takes you from hoping to knowing exactly what you're going to get. The buffers worked. So this is a period where it was tested, record volatility. These products did exactly what they were supposed to do. Now, if we go to the next slide, the power of knowing versus hoping, especially with your risk management, is, we think, of the utmost importance. When we look at some of these other strategies that were very popular in terms of hedging equity risk, we can see that they did not work in 2020. And a lot of people base their investment decisions on something like low volatility, which historically had given a downside beta of maybe 0.4 to 0.5 relative to the market. And so if you were maybe a little bearish when in 2020, you thought maybe the markets could drop 20, 15%, you would have expected that as the low volatility strategy would have offered some sort of downside buffer. Well, as I'm sure many of you are aware, it didn't. These products, they work until they don't. And it's because past performance is not indicative of future results. Low vol had a larger drawdown than the S&P 500. Dividends, a larger drawdown. A moving average, a switching strategy got you out, but didn't get you back in quickly enough. So you finished the year negative. That's the benefit of knowing, of having that certainty of a built-in buffer against losses. Now, again, this is PJAN and UJAN. I want to continue to point out our tickers because it helps people understand how these products can know what they own. P, power buffer. Jan, January series. That's our 15% power buffer January series. U, ultra buffer. Our 30% ultra buffer January series. If we go to the next slide, when we talk about the liquidity of ETFs, an ETF is only as liquid as its underlying components. These ETFs are constructed using a simple basket of options on the most well-known market benchmarks in the world: the S&P 500, the Russell 2000, the NASDAQ 100. When you look at the size of these markets, they are enormous. The S&P 500 has open interest, whether it's the S&P 500 ETF or S&P 500 index options. There are trillions of dollars of open interest in this space, and they trade hundreds of billions of dollars every single day, which means if you're looking to trade in size in one of these ETFs, as you buy shares of the ETF, shares of the underlying options would be purchased. So if someone were to buy $1 billion of one of our S&P 500 ETFs, we would be tapping into that market of SPY options that trade nearly $140 billion every single day. We would simply represent a very small portion of average daily trading volume. So these are liquid instruments. If we go to the next slide, the benefits of the ETF wrapper. I mentioned earlier that these ETFs or these payoffs have been around for decades. We did not create a defined outcome, but we introduced it into the ETF wrapper for the first time. And some of the main benefits are not unique to these. They're unique to all ETFs. Transparency, tax efficiency. Again, these products are not taxed until you decide to sell your shares. They're easily accessed. There's no surrender fees. There's no commissions. There's no credit risk that you have to explain to your client. And when we think about allocating buffers or defined outcomes across 30 or 40 client accounts, a number of our clients, our advisor clients, used to have to go individually to 30, 40, 50 different clients, get them to sign index annuity paperwork or enter in individual trades for structured products. Now, with the ETF, you can go out, you can buy as many shares, do a block print of the ETF, have all of your clients get executed at the same price. 1099 reporting. You can know exactly what you own within the ETF. We think that this simplifies the life of the financial advisor immensely. If we go to the next slide and bring back kind of what we were talking about at the very beginning, that equities are trading very rich, bonds do not look attractive. If you look at a 60-40 over the last 30 years, you can see that it delivered 8.8% a year. Mathematically, bonds cannot give you 6%. It's impossible over the next 30 years. So the returns are going to have to come from equities. But do you really want to have bonds in there? Because over the next 5-10 years, many are projecting 0 to 2% a year on bonds, perhaps even having some negative performance in there. That's where having the defined outcome ETFs, you can use them as a bond substitute. You could use them as a core equity substitute for conservative clients that need to stay invested in the market, but perhaps are wary of entering the market at all-time highs. Again, the power of knowing your potential outcomes before you invest is extremely valuable. On this slide, you'll see that we have defined outcome ETFs. We've talked about our buffer ETFs. We also have stacker ETFs. We have other defined outcome ETFs. We don't have time to go through them exactly, but the stacker ETFs essentially allow you to get a multiple on a well-known the U.S. equity market up to a cap and only have one-to-one downside. So a good example is we have a triple stacker ETF. It has a cap of around 18%, which means that if the U.S. equity market is up 6%, you would be up 18%. If the market's up 30%, you're still only up 18%. But again, high equity valuations today tend to bode poorly for high returns going forward. Again, this is a solution to ensure that you're hitting your equity return goals within your portfolio. Finally, if we go to the next slide, wrapping things up, we touched on our February series that it's coming due at the end of this month due to rebalance into a new outcome period. You can see again, B, buffer, Feb, BFEB. You can know exactly which ETF you own simply by looking at the ticker. This is the starting cap. These are the cap ranges. We won't know until the end of this month exactly what that number will be, but this is what we're seeing. So looking at PFEB for a 15% buffer, right now we're seeing caps between 9.3 and 10.9%, meaning you would participate in the first 9.3 to 10.9% of any future S&P 500 price return over the next 1 year outcome period. Those again, coming, you can purchase them now, or you could purchase them when the new outcome period begins. And if we just go quickly over the next two slides, this is our full lineup of buffer ETFs. I mentioned we have them on the S&P 500. We also offer them on the NASDAQ, Russell, EFA, emerging markets. And then if we go forward one more slide, we offer them on long dated bonds. And on the left-hand side of this chart, you can see these stacker ETFs and how, again, you can use these to ensure that you're hitting your equity return goals. So Todd, I know we went through a lot there, but I think we've got a few minutes for questions. So I'm going to turn it back over to you.
Thanks, Graham. I'll move us through the upcoming slides at a leisurely pace, which has disclosures, and folks can find in the handout section of this that they'll actually see the full deck that has all the information as well as all the disclosures. I'm going to open this up for questions. If you have questions, please send them to us. We got a couple of them throughout the presentation, and Graham, you touched on some of this, but I want maybe you can go a little bit more in depth. What happens at the end of an outcome period? So if somebody was already owning the February series, they own B, Feb beforehand. Can you explain the process of what happens? This doesn't shut down.
Yeah, exactly. No, it's an important distinction. It doesn't shut down. It's not like you had $100 in it. Now there's $110 in it. You're not just going to get a distribution of 110. You got to reinvest it. Think about it as a typical ETF rebalance. The S&P 500 rebalances on a quarterly basis. This is what happens with these ETFs. So in the case of BFEB, again, these products held 1-year options expiring at the end of this month. Once those options expire, we'll simply take the proceeds within the ETF wrapper and reinvest into a new basket of 1-year options. With BFEB, it'll give you a fresh 9% buffer, and then you'll have a fresh upside cap. So an investor, they can choose to sell. They can, if they do nothing, they'll be fully reinvested for the new outcome period. And so really, it puts the power back into the hands of the advisors to make a decision. They're not forced to sell or realize any sort of distribution.
Got it. And so let's stick with BFEB. We're a couple of days before the end of this 12-month period. At the end of the month, which, as you mentioned, will come on Friday. Let's assume that some of the audience is intrigued by this. Obviously, you'd be happy to have them as a client, but would you prefer that they waited? Do you think it's in their best interest to wait until we technically are in February, or is obviously there's liquidity of these ETFs today, but what's your suggestion?
Yeah, it's a great question, and again, one of the benefits of having the February series already be in market, we see a lot of advisors purchase prior to the start of the new outcome period. And the reason for that is rather than come in on February 1st and see the market is up 3%. Well, our products, although they're not going to track 1-for-1 with the S&P 500 at the beginning of the outcome period, they may be up 1 or 2%. Well, a lot of people are buying these buffer ETFs for that downside protection. And if they're up 1%, then they now have introduced, in the case of BFEB, 1% or 2% of downside before the buffer. And so purchasing prior to the end of the outcome period ensures that you are invested and you're essentially getting day one parameters by purchasing prior to the end of this outcome period. Now, the outcome period, you just have a couple days left, and the outcomes are relatively known given how much the market has run up since the beginning of these outcome periods.
So, obviously we're talking about the February series for good reason. We're almost at the end of it, and we're almost in February. But you mentioned earlier in April, for example, as an example, where there's obviously October and November. One, I guess, do you find that investors are buying in the middle of the period? And I guess more to, I think on your website, you've got tools to be able to help investors understand where we are from a cap and a buffer perspective. So they're not trying to do this on their own and understand the downside and upside that's available. Yes?
Yeah, no, that's a great question. We have the tools. So maybe an important thing to note is even though these offer defined outcome over the full 1 year, you can purchase these ETFs at any time, and you can still achieve a defined outcome. So even referencing our February series, even though there's just a few days left in the outcome period, you still have a defined outcome over the next 2 or 3 days. Same way if you're looking at, say, our October series. Well, our October series will expire or reset at the end of September. You would then have approximately an 8-month outcome period. You can still achieve a defined outcome. And if you go to our website, we have some pretty cool tools that allow you to evaluate all of our ETFs. In fact, there's tools that will show you that if the S&P 500, say, goes up 10%, here's what you can expect from all of our S&P 500 ETFs over the remainder of their outcome period. Or maybe you're looking and you're concerned about the equity markets dropping 15 or 20%. We have that tool. It'll show you, here's how each of these ETFs will perform if the market drops 15 or 20% over the remainder of their outcome period. So it helps advisors analyze which ETFs are best for their clients or best to meet their investors' needs.
And I'm going to squeeze in one last question here. In terms of just, you touched on the benefits of an ETF and the liquidity. These are not notes. You can trade them intra-period. Like I just pulled up April, which is the buffer April series that we showed earlier, and it trades about 20,000 shares a day. Obviously, it's in the middle of a period where a couple of months beforehand. Obviously, maybe you can speak to that in two ways. One, that there is volume that is already taking place on an average day, but then you touched on also that if somebody wanted to go and obviously trade an equal number as average daily volume, how that happens, obviously tapping into the liquidity of the S&P 500 and the options market. You want to spend a minute there if you can?
Sure. Yeah. So I think an important thing to note is the liquidity profile of all these ETFs. Again, if it's our February series or April series, it's all the same. And that's an important thing to remember, because you can come and maybe look at one of our ETFs and it's only traded a few thousand shares. You may think, well, I can't buy or sell in size. But again, remember that the liquidity of the ETF is tied to the underlying constituents that are held. And these are S&P 500 options, 1 year S&P 500 options. And regardless if you're 6 months from the outcome period, 11 months, 1 month, the market makers view the liquidity profile of these ETFs all the same. Why? Because it's just S&P 500 exposure. They're trading S&P 500 exposure across a number of vehicles, options, SPY, IVV, SPX. It's a massive liquidity pool. So regardless of which vintage, which monthly series you're looking at, there is a significant amount of liquidity. And so if you're not seeing what you like on the screens, give us a call. We were happy to help facilitate execution. We want to make sure you have the best trading experience possible as well. But know that there is ample liquidity to facilitate any size trade that you need with these ETFs.
Thanks, Graham. Great color. I'm going to move us forward. Thank you to the audience for submitting questions to show you two things. One, hopefully you've been joining us for our webinar series and been enjoying it. We're really excited about the next one. As an ETF guy, I'm excited that we're bringing this. We and our team, particularly Chris Kuiper, who's one of our equity analysts at CFRA, wrote perhaps the most popular article that we have on our platform in a long time, an investor's guide to Bitcoin. Obviously, Bitcoin has been moving up and down this year. We're going to go in depth about that. There is obviously no Bitcoin related ETF. They'll probably touch on what's going on in that world, but specifically making the case for what you should know about Bitcoin, how you should consider it with your clients' portfolios. A lot of great depth. There's a report that's available on MarketScope Advisor today, and he'll be going more in depth. In fact, there's a video on MarketScope Advisor today. Chris is going to go much deeper in the webinar. And I'd be remiss if I didn't just encourage you, if you're not using MarketScope Advisor, to see our thematic commentary, our coverage of individual stocks, ETFs, and mutual funds. You're missing out. We're putting out lots of great commentary, particularly during earnings season and particularly in the market volatility. I'll move us forward, which I think is my way of showing the disclosures and disclaimers that we have. A survey will pop up in a moment. We'd welcome your feedback. And most importantly, Graham, thanks for joining us and for sharing some great insights about the Innovator lineup and for specifically the defined outcome suite of products.
Yeah, thanks so much, Todd, for having me.
And thank you, everybody. Have a great rest of your day.